Good morning, class.
Morning, sir.
Okay, I am Jasper Nacua, CPA, CPD, your instructor for today. So, before we're going to start with our lesson, let us first have our prayer and sing of national anthem.
Please be seated.
Okay, so let us now go back to our discussion. But before that, let me first discuss to you my classroom rules. So during the duration of our discussion, the students must observe the following. First, you must listen attentively. Second, avoid unnecessary noises. Third, raise your hand if you want to answer or if you have questions regarding the topic. Next, do not talk when you are not permitted to do so. Next, do not laugh at your classmates when they answer questions incorrectly. And respect your teacher and your classmates. Okay, before starting to our said topic, let me first present to you the objectives of our lesson for today. So at the end of the session, the students should be able to first understand the concept of inventory. Second, describe its recognition, initial measurement, and subsequent measurement. Know and understand the three types of inventory valuation. And lastly, calculate the cost of goods sold and ending inventory using the different types of inventory valuation. Okay, so first and foremost, let us define first what is inventory. Okay, so as defined in Philippine Accounting Standards or PAS 2, paragraph 6, inventories are assets held for sale in the ordinary course of business, in the process of production for such sale, or in the form of materials or supplies to be consumed in the production process, or in the rendering of services. Therefore, inventories include the following. First, assets held for sale in the ordinary course of business, which is also referred as the finished goods. So this is commonly under the manufacturing business. And next, letter B, assets in the production process for sale in the ordinary course of business. So when we say production process, so it is not yet finished, rather. That's why it is called inventories under work in process. Third, or the letter C, is materials and supplies that are consumed in production, or this is what we call raw materials. Next, we have purchased subcomponents, and lastly, we have goods held by a trader for resale. So these are the components of inventory. Inventory may vary from the business you are into. If you are manufacturing, therefore you should have raw materials, work in process, and finished goods. But when your business is merchandising, then you have already that goods for sale, already for sale. So let's proceed to initial recognition and initial measurement of inventories. So when we say recognition, an entity should recognize an inventory only when, first, the entity controls the asset as a result of past events, and lastly, it is probable that future economic benefits will flow to the entity. So when we say the entity controls the asset as a result of past events, or there is a transaction involved, and there is a possibility that the inventory has or economic benefits in the future. So next we have initial measurement. So when you say initial measurement, the cost of inventory shall comprise all three, which are costs of purchase, costs of conversion, and other costs, which are incurred in bringing the inventories to their present location and condition. So these three also have components. So first, we have costs of purchase. These include the purchase price of the inventory. Second, the import duties and other taxes attributable to the bought or to the inventories purchased. And lastly, we have the transport, handling, and other costs directly attributable to the acquisition of finished goods, materials, and services. These kind of costs, the transport and handling costs, it should be directly attributable, because if it is not directly attributable to the acquisition of the goods, then it is considered as an expense rather than part of the costs of the purchase. Therefore, it is not capitalizable and thus only recognized as expense or outright expense. Next, we have costs of conversion. So costs of conversion include three. We have variable production overheads, fixed production overheads, and joint products. So first, we have variable production overheads. So these variable production overheads, these costs are commonly attributable to manufacturing type of business. So because it has variable and fixed production overheads. When we say variable, it is incurred per unit or per unit cost. While for fixed production overheads, these are costs which are already fixed or has already fixed amount. Next we have other costs. So it also has three components. We have borrowing costs, storage costs, and non-production overheads or costs of designing products for a specific customer. So these are the following costs which could be capitalized and should be measured in inventories. But we have to take note that there are costs which should be excluded from costs of inventories, because these costs is expensed rather than capitalized. So first, we have abnormal amounts of wasted materials, labor, or other production costs. Second, we have the storage costs. So as you may have observed, storage cost is part of Okay, storage costs is part of other costs, but it could be excluded or included depending on its use. If it is essential to the production process, or it's essential to the production process, therefore it is included in the cost of inventories. But if it is not essential, it is not for the production process, therefore it should be excluded from the costs of inventories. Next, we have administrative, unrelated to production. And next, we have selling costs. Selling costs are automatically expensed because it is for selling the inventories and not for the capitalizing the inventories. Then we have foreign exchange differences arising directly on the recent acquisition of inventories invoiced in a foreign currency. And then lastly, we have interest cost when inventories are purchased with deferred settlement. Okay, next, let's proceed to subsequent measurement of inventories. So accordingly, inventories are required to be stated at the lower of cost and net realizable value, or NRV also. So in short, inventories are subsequently measured using LC and RV. So we have two variables here, or two costs stated. We have the cost and the net realizable value. So whichever is lower should be the costs of the inventories. And then next, inventories are usually written down to net realizable value item by item, or in an itemized manner. However, it may be appropriate to group similar or related items in some instances because it would be too time-consuming for you to itemize it one by one, where in fact it could be grouped because it is of similar product or related items. So, with that, you can maximize your time and effort through grouping them because they are also the same or related to each other. Next, NRV, or the net realizable value, is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated costs necessary to make the sale. So that is the net realizable value of inventories. Okay, we already have learned about the inventories, its definition, its initial recognition, initial and subsequent measurement, as well as initial and subsequent measurement. So now let's proceed to the inventory valuation. So when we say inventory valuation, that is how we measure, we calculate, we evaluate inventories. So there are many ways on how we are going to measure and calculate inventories. It depends upon the nature of the business as well as the entity itself on which of the following types or ways they are going to choose. So I have specifically narrowed here three types of inventory valuation. We have first the FIFO, or what we call the first in, first out. Second, we have the weighted average, which is periodic, and the moving average method, which is perpetual. So let us define these three types of inventory valuation. So first we have FIFO, or the first in, first out. So FIFO, or the first in, first out, assumes that any item sold was the oldest item purchased and still be held, and therefore the items remaining in inventory at the end of the period are those most recently purchased or produced. The FIFO method is generally used since it is most likely to approximate the physical flow of goods sold, resulting in the most accurate measurement of cost flows. So from the term itself, it is already understandable. From the word first in, first out. What comes first must came out first. So therefore, those first purchases must must or is assumed that those products or inventory should came out first. So it is assumed that the inventory left during the course of the business or at the year end. So the inventory left is assumed that that the valuation of these must must adhere to the latest purchase rather when it comes to valuating it. So we will provide examples later, but we would continue first to define weighted average periodic and moving average method perpetual. So we have weighted average periodic. So this allows you to mingle the costs of similar items purchased and use weighted averages to measure inventories held either on a periodic basis or as each shipment is received. This is used in packaged inventory systems that are computer controlled, in which results are not that different from 5. So when we say weighted average, this is somewhat the easiest way to determine the cost of goods sold and the ending inventory of the inventories. Because we're just going to get the average cost of the purchases made during the year or during the course of the business, or it may be yearly, annually, semi-annually, or monthly, whenever you choose. You're just going to get the weighted average cost or the average cost. So after that, you're just going to multiply it by the purchases and as well as the ending inventory and as well as the units sold, and that you're going to get the cost of goods sold or the cost of sales, and of course the valuation of ending inventory. Lastly, we have moving average method, or this is somehow used in perpetual inventory system. So this is the same as the weighted average, since it uses an average cost to compute for the inventories, cost of goods sold, and ending inventory. However, the only difference is that the average cost moves or changes as the entity purchases inventories or a customer returns an inventory from the sale transaction, while weighted average or periodic constantly uses one distinct average cost. So it both uses average cost to determine the cost of goods sold and the ending inventory of the entity in a particular period. However, the weighted average periodic constantly uses one distinct average cost. So while the moving average method changes every purchases of the entity made. So it may increase or decrease depending on the value or the cost of the purchases of inventories by the entity. So let us now proceed to the example. So, example here states that the Sony company sells blankets for 30 pesos each. The following was taken from the inventory records during July. So, during July. So, the table here states we have date, product T, the units, and its cost. We have here July 3, which is purchase. The entity purchased 500 units of products with a cost of 15 pesos. While on July 10, the entity sold 300 units of products. Then on July 17, the entity purchased again 1,000 units of products, which has a cost of 17 pesos. And on July 20, the entity sold 600 units of products, and on July 23, the entity again sold 300 units of products. And lastly, on July 30, the Sony company purchased 1,000 units of products with a cost of 20 pesos. So, we're going to determine the cost of goods sold or the cost of sales and the ending inventory valuation of each of the following method or types of inventory valuation. So first, using the FIFO, the first in, first out. So as we may have observed in the table, okay, so we have here, as we may observe, Sonic. Bukan.
Resulting.
Yeah, nagsulat na lang kung mali na na. Since rather.
What do you call that? Ending.
Okay na lang, dito na ko. Sige na, continue na ta. Okay, using FIFO, we have here cost of sales, as you may observe in the table that we have foreseen before. We have 3 sales transaction. We have here, first sale transaction involved 300 units sold. Second transaction involved 600 units sold. And then the last sale transaction involved 300 units of products sold with a total of 1,200 units sold. So we are going to compute here. So you have the date, the quantity, unit cost, and the total cost. So on July 10, the sale on July 10 involved 300 units of sales. So multiply by the 15 pesos unit cost. So it has a total cost of 4,500. On July 20 sale, so since it is first in and first out, and the purchases made before still has 200 units left of 15 with a cost of 15 pesos. Therefore, we must first evaluate that before we're going to proceed to the next purchase, to the next group of products with a cost of 17 pesos each. So we have 200 times 15 pesos equals 3,000 pesos. And then the remaining sale transaction of July 20, which has a unit of 400 units, will be multiplied by 17 pesos. So 400 times 17 is equal to 6,800 pesos. And then on the July 23 sale, we have 300 units. So 300 times 17 is equal to 5,100 pesos. So total cost of sales equate to 19,400 pesos from the 3 sales transaction. So that is the cost of sales or the cost of goods sold. On the other hand, in computing cost of ending inventory, let us take into account the purchases, the purchases transactions and the sale transactions. So we have to add all the purchase transactions. We have 500 plus 1,000 plus 1,000 less sale transaction of 300 plus 600 plus 300 with a remaining inventory of 1,300 units. Okay, so when we are going to evaluate ending inventory using FIFO method, let us start from the latest purchase date. So the latest purchase date is on July 30 with the units of 1,000. So since the ending inventory left is 1,300, therefore, the remaining 300 should be valuated from the July 17 purchase date. So let us multiply 300 times 17 is equal to 5,100, and then 1,000 times 20 is equal to 20,000. So our cost of ending inventory amounted to 25,100 pesos. Okay, let us proceed to the next type of inventory valuation using weighted average per unit. So this is the easiest way. We're just going to add the total cost, and then add the total cost and add the total quantity, then divide the total cost to the quantity, and then it will have the average unit cost of the average unit cost. So first, let us add the quantity. So purchases, we have July 3, 17, and 30. So in July 3, we have 500 units purchased. July 17, 1,000 units purchased. July 30, 1,000 units purchased with a total of 2,500. And its cost amounting to 7,500, 17,000, and 20,000 with a total cost of 44,500. Then, let us divide 44,500 by 2,500. So, it will arrive to the unit cost of 17 pesos and 80 centavos. So, this cost will be our basis in computing the cost of sales or cost of goods sold and the cost of ending inventory. So, when computing cost of sales, let us all add the units sold in during the month. So 300 plus 600 is equal to 900 plus 300 equals 1,200. So 1,200 times 17.80 is equal to 21,360. So that is our cost of sales. In computing cost of ending inventory, we are going to account for how many units of inventory was left. So based on the given data, 1,300 of the inventories are not yet sold. So therefore, 1,300 times 17.80 is equal to 23,140, and that serves as our cost of ending inventory. So it's quite easy rather than the other types of inventory valuation. And lastly is the moving average perpetual, or the usage of moving average perpetual. So in using moving average, we must account or separate inventory from the cost of merchandise sold in order for us to evaluate the ending inventory and the cost of inventory left easier. So first, in July, the July 3 transaction is a purchase, therefore we must account it as part of the inventory. We have 500 and the unit cost of 15 pesos. So 500 times 15 is equal to 7,500. Okay, on July 10, we have a sale transaction of 300 units. So 300 times 15 pesos is equal to 4,500. We're going to subtract that from the units, from the purchased units. So we only have a balance of 200. 500 less 300 is equal to 200. And 7,500 less 4,500 is equal to 3,000. So with the sale transaction must be accounted and must be recorded in the cost of merchandise sold column. So next, from that balance, on July 17, the entity purchased merchandise worth 1,000 units times 17 pesos, which is its unit cost, which has a total cost of 17,000 pesos. So, since the entity purchases merchandise, therefore, the cost of the merchandise will change. So by that, we're going to add the purchased merchandise from the balance. So we have 200 units, which is the balance, plus 1,000 units of purchased goods is equal to 1,200 units. And then, let us add the cost. 3,000 pesos plus 17,000 pesos is equal to 20,000 pesos. Okay, so from this data, we are going to divide the total cost by the quantity in order to get the new average cost of the product. So we have 20,000 divided by 1,200 is equal to 16.67. So this 16.67 is the new valuation, the new cost of the merchandise to be sold. Okay, so for the next transaction, we have July 20 is a sale transaction. Therefore, we must subtract this from the balance. But in accounting for the next sale transaction, we are now going to use 16.67 rather than 15 because the price already, or the average price already changed. So 600 units times 16.67 is equal to 10,000 pesos. And then we're going to record this to the cost of merchandise sold. 600 rounded up. 600 times 16.67 equals 10,000. Okay. So we have a balance of 600, 1,200 less 600 is equal to 600. 20,000 less 10,000 is equal to 10,000. And then next, again, a sale transaction. So we have 300 units sold. Okay, 300 times 16.67 is equal to 5,000 pesos. So we're going to record again this to the cost of merchandise sold column. And then we only have a balance of 300 units, which equates to 5,000 pesos of total cost. And then last transaction is a purchase transaction. Therefore, since it is a purchase transaction, our unit cost or average price will change again. So we have first to add the quantity and the total cost. So 300 plus 1,000 is equal to 1,300 units. And then 5,000 pesos plus 20,000 is equal to 25,000 pesos. So 25,000 divided by 1,300 pesos is equal to 19 pesos and 23 centavos. So that 25,000 is our ending inventory cost. And then, to account for our cost of goods sold or the cost of sales, let us add all the cost from the sale transaction. We have 4,500 plus 10,000 plus 5,000 is equal to 19,500 pesos. So therefore, our ending inventory amounted to 25,000 pesos. And then our cost of sales amounted to 19,500 pesos. Okay, for your assessment, we have here a table and a problem. And the requirement is to determine the cost of sales and the cost of ending inventory under the three assumptions or methods, which are the FIFO method, weighted average per unit method, and the moving average perpetual method. Okay, your timer starts now, 5 minutes only. Okay, from your given answer, so as I have observed that your answers are all correct. Very good. Pick up your hands. Okay, what an excellent work, Mr. Jerry. Okay, so since our assessment was done, let us now proceed to our review questions. First, what is inventory? Mr. Jerry?
So, sir, as defined in the Philippine Accounting Standard 2, paragraph 6, inventories are assets held for sale in the ordinary course of business, in the process of production for such sale, or in the form of materials or supplies to be consumed in the production process or in the rendering of services. Therefore, sir, inventories includes the following. First, the asset held for sale in the ordinary course of the business as or finished goods. Second, the assets in the production process for sale in the ordinary course of the business or the work, or also called as work in process. So, and next, the materials and the supplies that are consumed in the production or the raw materials. Next, the purchase subcomponents, and lastly, the goods held by trader for resale.
Okay, very good. So that ends our session for today. Thank you so much for listening. And
Thank you, sir.
again, I am Jasper Dancy Nacua, your instructor. Have a good day.
Bye, sir.